Every trader, when opening a chart, must first ascertain the market's direction, essentially, whether it is trending bullish or bearish. In this video, I will explain daily bias as simply as possible. A proper daily bias is the crucial first step that every trader must master. So, what exactly is daily bias? Bias refers to the price direction. Are we moving up or down? Daily bias is essentially the prediction of market direction and sentiment for the upcoming day. Bias is not a fixed element. It is not always clear what the market will do at every moment of the day. Daily bias is simply the direction you anticipate the current daily candle to close. In simple terms, you know whether buyers or sellers are in control. Are you bearish or bullish? Now, why is this important? Well, when daily bias is clear, trading becomes very easy because you're only focusing on one side of the market. All you have to do is wait for your trading session and then look for an entry model, which can be as straightforward as a market structure shift or other types of entries. One vital concept for traders to understand is that the market operates based on probabilities. This means that certain events are more likely to occur than others. Nothing in trading is guaranteed. However, if we can achieve, for example, a 90% probability in our favor, it's highly likely something will happen. I used to believe it was crucial to always know the bias at every moment. If I didn't, I felt like I was missing something. Many traders share this mindset, but it's important to realize that this line of thinking is misguided. Bias is not a fixed element. It is not always clear what the market will do at every moment of the day. Now, why is it important to determine daily bias, and what psychological aspects are involved? First, higher time frame levels hold greater significance. A minor reaction at a key level on a higher time frame can lead to a notable trend change on lower time frames. Before executing any trades, it's important to assess how close the price is to hitting a supply or demand area on the higher time frame. This understanding will guide you in setting targets, stop losses, and in avoiding losses. For instance, on the pound-dollar 4-hour chart, we observe a strong downtrend. However, after failing to set a new lower low and bouncing off this level twice, the market reversed. If we shift to the weekly time frame, we can see that this area acts as a significant key level. Thus, despite ongoing bearish momentum on the hourly chart, a temporary reversal occurred. Understanding these higher time frame key levels is crucial because they indicate where significant price levels lie and where the market tends to react due to their stability and reflection of long-term trends. Second, improving success rates. The best trading opportunities arise when the higher and lower time frames are aligned. For instance, if we notice liquidity on the lower time frame breaking above previous market structures, a pullback to an FVG zone could present an ideal long entry. By placing a stop loss below the FVG and targeting the upcoming market structure level, traders can enhance their profits. If the lower time frame's analysis aligns with a bullish movement observed on the higher time frame, this sets up a strong trade due to the combination of higher and lower time frame data. The core psychology behind analyzing daily bias and smart money concepts is tracking institutional trader behavior, which helps us plan our entry setups according to this bias. So before we get into daily bias, I want you guys to understand there's 4 reasons why markets move. Number 1, markets move to hunt liquidity. Number 2, markets move to rebalance inefficiencies, which are fair value gaps. Markets move to rebalanced equilibrium and generate liquidity. Understanding which side is in control is vital in trading, as it can prevent unnecessary losses. Let's dive into how to pinpoint daily bias using smart money concepts. Daily bias allows traders to make confident, informed decisions about the market's likely movement, helping them focus on optimal setups rather than second-guessing their trades. We will focus on 3 main aspects to identify daily bias: market structure in HTF, liquidity areas, and fair value gaps. By combining these elements, we can determine the next market moves effectively. Number 1 is analyze market structure on higher time frames. Begin by examining daily or weekly charts. Higher time frames provide a comprehensive view of the market, keeping your analysis in line with the broader trend. Identify the current dominant trend, whether it is bullish, bearish, or range-bound. Additionally, highlight significant support and resistance areas on these higher timeframes, as these can indicate crucial levels where price may reverse or break through. An important technique for traders is mapping market structure on 1-hour or 4-hour timeframes. These mid-range charts yield more reliable and actionable insights than lower timeframes, which can produce misleading signals. Begin by determining the general trend on these timeframes, identifying major highs and lows. For instance, if the price consistently forms higher highs and higher lows, the market is in an uptrend. Conversely, if it creates lower highs and lower lows, the market is downtrending. If there is no discernible structure, the market might be consolidating or ranging. After establishing the price's overall direction, look for breaks of structure. A break of structure occurs when the price surpasses a significant high or low in line with the prevailing market trend. For example, if the price closes below a major low, it signals a bearish break of structure. On the other hand, a bullish scenario is indicated when the price breaks above a major high. However, if the price in a downtrend breaks beyond a significant high, it suggests a change in market character or structure, and the same principle applies in an uptrend. By following these steps, can better evaluate market conditions and set a clear direction for daily bias. Next, let's discuss the significance of fair value gaps on the chart in determining the daily bias. A fair value gap signifies an imbalance between buyers and sellers. Understanding fair value gaps is crucial, as they are intertwined with candle patterns. Fair value gaps emerge from a specific three-candle formation. This illustrates a buying imbalance where buying pressure has greatly surpassed selling pressure, potentially due to institutional activity. The market often enters an inefficient state, leading it to return to the fair value gap area to correct it. For smart money traders, identifying fair value gaps should be one of your first steps when analyzing a trading chart. Your attention should immediately focus on these gaps. The presence of these gaps suggests that major players have impacted the market, and prices typically return to these levels to capture any remaining orders, creating potential trading opportunities assuming there are still orders available. Therefore, when we identify a bullish or bearish fair value gap, it gives us a certain degree of probability regarding price movement. How do we find quality fair value gaps? If we're bearish, the highest probability fair value gaps will be found in premium pricing, the top half of the daily range. Here's a bullish example. High probability fair value gaps occur after a liquidity sweep followed by a change in the state of delivery. In this bullish example, a fair value gap is created at equilibrium after displacement and offers an entry at a discounted price. For instance, on the pound-dollar weekly chart, we observe a bullish trend with the last impulsive move starting from near here and continuing upwards. The buy-side imbalance, visible through large candles, indicates the presence of a fair value gap. Since the price is currently in a sell-side inefficient state, it needs to return to the fair value gaps to fill them, potentially presenting us with trading opportunities. As we see another sharp move upwards creating a fair value gap area, price then retraces back to this area, rejects the fair value gap, and continues heading higher. This concept applies across time frames. Examining 5-minute, 1-hour, daily or weekly charts, you will also find fair value gaps. The next we're going to talk about is liquidity, which serves as the lifeblood of the market. It's often said that liquidity drives price movement. Liquidity zones act like magnets for price, helping to address imbalances between supply and demand in the marketplace. There are two main types of liquidity, dynamic and static. For effective daily bias determination, however, we need straightforward, empirical concepts. Dynamic liquidity consists of two essential components, internal and external liquidity. Imagine these as parts of a continuous cycle where price oscillates between internal and external liquidity. This interaction plays a vital role in influencing price movements. External liquidity. This refers to buy-side and sell-side liquidity located outside of the current trading range, typically found at significant levels like swing highs and swing lows. Internal liquidity. On the other hand, internal liquidity encompasses the liquidity present within the current trading range, where most trading activity occurs. This includes order blocks, fair value gaps, volume imbalances, and trend line liquidity elements formed within the active trading range. As mentioned earlier, the market constantly fluctuates between external range liquidity and internal range liquidity, often represented by fair value gaps on the chart. To illustrate this, consider a scenario where the price moves upwards toward external range liquidity, surpassing a swing high. After tapping into this external liquidity, the price typically retraces to address internal range liquidity, specifically filling a fair value gap. This action is part of the market's natural rebalancing process. Once the fair value gap is filled and internal liquidity is accounted for, the market shifts focus back outward, seeking the next available external liquidity pool, often resulting in a new swing high. If you're wondering how to integrate this concept into your trading strategy or determine your daily bias, recognizing areas of external and internal liquidity can effectively indicate the market's next move. For instance, in an uptrend, if the price respects an established bullish fair value gap, it signals a likely continuation toward buy-side external liquidity. Conversely, if the price decisively breaches this fair value gap with strong bearish momentum, it implies a shift toward sell-side external liquidity, which may indicate a change in market structure. To set your daily bias accurately, identify both mitigated and fresh fair value gaps near the current price. This practice enhances your ability to interpret price action more clearly. Next, let's discuss another static liquidity. This refers to market areas where liquidity remains stable or concentrated over time, primarily due to large resting orders like limit, stop loss, or take profit orders that are positioned at critical price points. These areas tend to draw price movement. Identifying static liquidity zones is essential for establishing daily bias, since smart money and market makers often utilize these areas to fill their orders and influence prices in their favor. Key types of static liquidity include equal lows and equal highs. Static liquidity commonly accumulates below equal lows or above equal highs, where numerous stop-loss orders are situated. These zones become targets for liquidity sweeps before the market reverses direction. Swing highs and lows. Similar to equal highs and lows, liquidity also gathers just beyond swing highs and lows, where traders place their stop orders. For example, a swing high might represent buy-side liquidity that could be targeted for future profit-taking. Dynamic trend lines and channels also attract liquidity. When the price approaches the outer edges of these trend lines or channels, liquidity is typically found just above or below these boundaries. Another important aspect of determining your daily bias is recognizing recent liquidity sweeps. Look for these sweeps and stop hunts near key static liquidity areas, such as significant highs and lows or major supply and demand zones. The core concept is straightforward. When sell-side liquidity is cleared via a liquidity sweep, the price generally advances toward buy-side liquidity, and vice versa. This understanding aids in anticipating the market's subsequent movement, particularly on 30-minute, 1-hour, and 4-hour time frames. Liquidity sweeps provide additional confirmation for trades. Simply put, the market needs liquidity to build momentum. If the price doesn't clear liquidity prior to reaching a significant level, it often uses that area to gather the necessary liquidity for the next move. For instance, if the price sweeps buy-side liquidity above a major high and then closes below its range with the next candle, it suggests a higher likelihood of moving toward sell-side liquidity below the current price. If this aligns with the prevailing market direction, it indicates a strong selling opportunity. Conversely, a liquidity sweep that contradicts the dominant trend suggests a potential reversal, even if temporary. Now, let's put all these insights together to identify the higher time frame bias. Your higher time frame analysis should typically be 2 times higher than your entry time frame. Generally, we consider the 4-hour, daily, and weekly charts for overall market bias. On the pound-AUD's weekly chart, we can see distinct bullish movements. The latest bullish break of structure identifies a bullish trend, and we know bias is bullish and we should find buy setup. The first question is, where is the liquidity? We know that lots of liquidity is gathered below this demand area, so a rundown below this line can engage the sell-side liquidity, which is another confirmation that the price can continue pushing upwards. Now, do we have an FVG in the latest move? The answer is yes, we have a fair value gap area which, if we apply the retracement tool, we can see that it is located in the premium zone, so forming a fair value gap in the premium area could be a perfect trading opportunity. So we expect the price to return to the FVG to patch it over, and then we can look for reversal confirmations in the lower time frame to go buy. Okay, if this video was helpful, please give it a thumbs up, as it greatly supports the creation of more content like this. Thank you for watching, and see you in the next episode.